Hey everybody, welcome back to the channel. So today I wanted to talk about the concept of the price to earnings ratio and why you should not be afraid of a price to earnings ratio of 30 or more. And we often see, headlines like this which say that basically, certain companies trade at a very high PE and therefore are overvalued. But I think that's a bit too narrow of a definition. And so, value investors who look at just the PE ratio and expect a low PE ratio before they buy into a company, I think that is a bit short term. So, let's look at the case of Amazon in a bit more detail. So, of course, if you see the stock price, you can see that Amazon has outperformed the S&P for the last 10 years by a huge margin. So, let's look at the theory that the PE was too high. So of course, if you look at the pure number, you can see that the PE has always been very high. If you look at this point in 2010, it seems the PE was about 81 point. Let's get it here, 81.95. But there's actually more to the story. If you look at the 3-year median, it doesn't seem that much better. The PE seemed very high here as well, about 64, a bit lower but still high. If we look at the 3-year mean, it still seems a little high at 69. But the thing about Amazon is that it actually invests a lot in warehouses and fulfillment centers, and that eats away into a lot of its profits. So the real way to look at Amazon will actually have been to look at the EBITDA, or the free cash flow. And I'm going to use the multiple of EV, which is enterprise value, to EBITDA. Enterprise value minuses out the net cash. So a company like Amazon or Google or Facebook, they have a lot of extra cash. So you don't want that to be part of your valuation multiple. So you want to remove that and you want to look at the pure earnings against the market cap minus the net cash. So when you look at the EV against EBITDA multiple, you see a much more clearer picture. So at that same period in 2010, you see that the EV to EBITDA multiple is much more reasonable. It's about 33. And you see it's been hovering around that value for, the last 10 years. So if you had not bought Amazon because you felt the PE was too high, you would have missed out a lot. If you look at the EV against free cash flow, you see something similar. There might be some spikes here, but that could be because these could have been years where Amazon was heavily investing a lot of money into its warehouses or fulfillment center, and so that really depressed the free cash flow. But generally, it's been in that kind of range. So there may be some companies that don't have any profit or have very little profit. In those cases, you might want to look at the price to sales ratio, and I've done another video on the price to sales ratio. But remember, when you're looking at the price to earnings ratio, make sure it's accurate. And in the case of Amazon, we saw that looking at the price to EBITDA or price to free cash flow metrics would have been much better. The other example I want to look at is the case of Visa. So Visa has, as well as outperformed the S&P by a huge margin. So Visa doesn't invest as much in data centers or fulfillment centers or warehouses. So we don't need to look at the EBITDA here or the free cash flow. We can actually look at the price to earnings ratio. And the price to earning ratio has always been high for Visa. If you look at it over the 3-year mean, which I think is better because you want to average out certain years where they might be low PE or high PE. But if you look at it from here, from the start, it was around 30 as well. And 10 years later, it's still around 30 or even higher than 30. So again, if you have missed out on investing in Visa because you felt the PE was too high 10 years ago, you would have lost a lot of good returns. The thing to note is that great companies will always trade at a very high multiple. And we'll compare this against Ford and American Express a bit later. And it's not that Revenue growth was particularly high in 2010. It was 9.95, and it's hovered around that range, the low teens. So, but the PE ratio has been quite consistent, and that's probably because is a very high quality company, and that's what you want to focus on when you're investing. You want to focus on companies which are very high quality, which have a strong moat, and there are certain qualitative metrics I looked at in my past videos. So if you want to learn more about modes and qualitative metrics, you can look at some of these other videos that I put in the description. One of the reasons Visa has had such a high PE ratio for the last 10 years is because it has a very strong operating margin. And if you compare Visa against, for example, Ford, you can see a vast difference in terms of the operating margin. Visa has operating margin of close to 62, while Ford has a operating margin of 2 or 3 at best. And so that explains why there's such a big discrepancy between the PE ratio of Visa and Ford. And even American Express, which is a company closer to the industry Visa is in, doesn't have such a high multiple, because it doesn't have such a strong moat as Visa. There probably wouldn't be a merchant that would accept American Express but would not accept Visa. Visa has become so ubiquitous because it has created such a strong network effect among not just the merchants but the consumers. And that's because of its partnerships with different banks. American Express has chosen to go it alone in having its own closed loop payment system. So while that can still be profitable, the partnership route for Visa has proven to be much more profitable, and it's secured its very high operating margins through that. So I think you learned from this video that you shouldn't be afraid of a high PE. In fact, sometimes a high PE might be a sign of a great company, and it might be worth investigating more. Thank you, and have a great day.